Welcome to StockTok's deep dive into Bristol-Myers Squibb. Bristol-Myers Squibb is a multinational biopharmaceutical company that discovers, develops, and commercializes a broad portfolio of prescription medicines across oncology, immunology, cardiovascular disease, and cell therapy. At the time of recording, the stock is trading at $57.78. Over the trailing 52 weeks, the company has traded as high as $62.89 and as low as $42.52. The 50-day moving average sits at $59.25, while the 200-day moving average is at $50.78. The Relative Strength Index, a momentum oscillator that measures the magnitude of recent price changes, stands at 44.4, suggesting a neutral technical setup. This positions us well to examine what the fundamentals actually tell us. Let's work through the analysis, scene by scene, starting with a quick business overview. Bristol-Myers Squibb operates as a large-cap biopharmaceutical manufacturer with a portfolio concentrated in high-value therapeutic areas including oncology, immunology, cardiovascular disease, and cell therapy. The company's competitive moat rests primarily on its patent portfolio, regulatory exclusivity through the FDA approval process, and significant research and development capabilities. These barriers create pricing power and switching costs that are difficult for competitors to overcome. The StockTok score for Bristol-Myers Squibb is 44 out of 100, which signals caution to investors. This score reflects mixed fundamentals across 5 key dimensions. Valuation receives a score of 7 out of 20, indicating stretched valuations. Financial health scores 11 out of 20, suggesting moderate concern. Profitability scores 15 out of 20, showing solid underlying earnings power. Growth receives only 3 out of 20, the weakest dimension. Smart money sentiment scores 8 out of 20, suggesting limited institutional enthusiasm. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Bristol-Myers Squibb trades at a trailing 12-month price-to-earnings ratio of 17.44 times. This is meaningfully above the historical pharma sector average, which typically trades in the low to mid-teen multiples. The forward price-to-earnings ratio, however, tells a different story. At 9.6 times based on Wall Street's next 12-month earnings estimates, it suggests the market is pricing in either earnings growth or that current valuations will moderate. The price-to-earnings growth ratio, or PEG, stands at 3.49. A PEG above 2.0 is often considered expensive, as it suggests investors are paying a premium relative to expected earnings growth. The enterprise value to EBITDA multiple, that is, the company's total value divided by its earnings before interest, taxes, depreciation, and amortization, sits at 10.46 times, which is reasonable but not cheap for the pharmaceutical sector. The price-to-sales ratio is 2.55 times, indicating that for every dollar of annual revenue the company generates, the market is willing to pay $2.55. In our view, Bristol-Myers Squibb's competitive moat around patent protection, regulatory exclusivity, and R&D capabilities provides genuine pricing power and barriers to entry. However, the data suggests this moat is increasingly under pressure from patent cliffs, the points at which major drug exclusivities expire, and potential regulatory action around drug pricing. GuruFocus Value, which is a proprietary intrinsic valuation model, places the fair value at $55.02. At the time of recording, the stock trades at a premium to this estimate, giving a margin of safety of negative 9.36%. Meaning the stock is trading above what this valuation model considers fair value. Wall Street analysts at the time of recording have a consensus mean price target of $63, with a high target of $75 and a low target of $40. This represents a range of perspectives among 25 analysts covering the name. The next earnings report is due April 30th, 2026, with the street expecting earnings per share of approximately $1.42. Market sentiment around Bristol-Myers Squibb. As of the creation of this video, leans bullish. Analyst upgrades are citing 16% upside potential, and industry observers are highlighting recent pullbacks as potential buying opportunities. However, this sentiment is tempered by broader pharmaceutical sector concerns, particularly around potential tariffs on patented drugs that could impact industry-wide margins. In our view, the valuation presents a mixed picture. The forward multiple looks reasonable, but the premium to intrinsic value and the elevated PEG ratio suggest caution at current levels. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point fundamental quality checklist that evaluates whether a company's balance sheet is improving or deteriorating. Bristol-Myers Squibb scores 8.0 out of 9, which is a strong signal. This tells us that most of the company's fundamental financial metrics are moving in a positive direction. The Altman Z score is a bankruptcy risk model that combines 5 weighted financial metrics to estimate whether a company is at risk of insolvency. Bristol-Myers Squibb Z-score is 2.32, which places the company in the gray zone. To clarify, a Z-score above 2.99 generally indicates low bankruptcy risk. A score between 1.81 and 2.99 falls in the gray zone where risk is uncertain, and below 1.8, one signals high distress risk. Being in the gray zone warrants monitoring, but is not an immediate red flag. Now let's examine the debt picture. The cash-to-debt ratio is 0.23, meaning the company holds about 23 cents of cash for every dollar of debt. This is on the lower end of the spectrum and suggests limited financial flexibility. The debt-to-equity ratio is 2.55, indicating that for every dollar of shareholder equity, the company carries $2.55 of debt. This is elevated and characteristic of leveraged pharmaceutical companies that have funded acquisitions or restructurings through debt. Interest coverage stands at 7.26 times, meaning the company's operating income covers its annual interest expense 7.26 times over. This is a solid coverage ratio and suggests manageable debt service. The current ratio, which measures short-term liquidity by comparing current assets to current liabilities, is 1.26. A ratio above 1.0 indicates the company can cover its short-term obligations, but a ratio below 1.50 leaves limited cushion in a stress scenario. In our view, Bristol-Myers Squibb's balance sheet shows financial discipline with strong underlying fundamentals, but elevated leverage relative to peers introduces concentration risk. The strong Piotroski score is encouraging, but the gray zone Z-score and the elevated debt-to-equity ratio warrant ongoing vigilance. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is perhaps the most important measure of operational efficiency. It tells us what return the company generates on every dollar of capital it deploys. Bristol-Myers Squibb's return on invested capital is 13.01%. In our view, this is solid but not exceptional. As a reference point, high-quality compounders in the pharma sector often achieve return on invested capital in the 15 to 20% range. At 13%, Bristol-Myers Squibb is generating reasonable returns, but trailing peers with superior competitive advantages. Gross margin, that is, the percentage of revenue that remains after direct production costs, stands at 71.08%. This is very healthy and reflects the pricing power inherent in patented pharmaceuticals. Operating margin, which measures profitability after all operating expenses, including research and development, is 28.47%. This is exceptionally strong and demonstrates that even after heavy R&D investment, the company converts a substantial portion of revenue into operating profit. Net margin, the percentage of revenue that flows through to net income after all expenses and taxes, is 14.64%. This represents solid conversion of revenue into bottom-line earnings. Free cash flow margin, which measures the cash the company generates after capital expenditures, is 26.65%. This is impressive and indicates that Bristol-Myers Squibb is highly efficient at converting sales into cash. In our view, the profitability profile is one of the company's key strengths. The margins across the board, gross, operating, net, and free cash flow, are all well above industrial average and reflect the inherent structural profitability of the pharmaceutical business. However, investors must note that these margins are under pressure from patent expirations and potential regulatory action on drug pricing, which could compress these metrics over time. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years stands at 1.40%. To put this in perspective, that annualized growth rate is extremely modest and well below overall GDP growth. Over the trailing 5 years, revenue growth accelerates slightly to 4.60%, which is still quite subdued. This deceleration in top-line growth is a critical observation and reflects the maturation of the company's patent portfolio and the lack of sufficient blockbuster pipeline success to offset expiring exclusivities. Book value growth, that is, the growth in shareholder equity per share, over the trailing 3 years is negative 15.40%. This negative growth tells us that retained earnings and capital accumulated in the business are being depleted or returned to shareholders faster than new capital is being built. This is often seen in mature companies with significant dividend payments or buyback programs. The dividend yield stands at 4.15%, which provides income to shareholders, but also represents a drag on equity accumulation. In our view, the growth picture is the weakest component of Bristol-Myers Squibb's investment thesis. Single-digit revenue growth combined with negative book value growth creates a setup where the company is essentially harvesting its existing assets and returning cash to shareholders rather than investing for future expansion. This is characteristic of a mature, cash-generative business in long-term decline, and it explains the low growth component score in our overall assessment. Investors must ask themselves whether they are buying a slowly declining but profitable cash machine, or whether they believe management's pipeline will reignite growth. The data suggests the former is more likely than the latter. Now let's talk smart money. What institutional capital is actually doing with this name? According to Dataroma, which tracks the holdings of value and growth superinvestors, 23 top-tier gurus currently hold Bristol-Myers Squibb. This is meaningful institutional interest, but not overwhelming. The top 3 guru holders are Hillman Value Fund, which holds Bristol-Myers Squibb as 3.53% of its portfolio, but recently reduced its position by 11.45%. Richard P. Zena through P. Zena Investment Management holds the stock as 3.37% of his portfolio, but recently reduced that position by 4.72%. And Bill Miller through Miller Value Partners holds the stock as 2.05% of his portfolio with no recent change. Notably, Kahn Brothers Group, which holds Bristol-Myers Squibb as 1.93% of its portfolio, recently executed a significant reduction of 25.75%, suggesting they may be taking profits or rotating capital elsewhere. Ariel Investments, however, has been a buyer. Among all 13 F-filers, that is, institutional investors who hold stock positions, only 13.9% are net buyers with greater than 50% increases in their holdings. Anything above 50% would signal net bullish sentiment from the institutional community. In our view, 13.9% represents relatively muted enthusiasm. The fact that major gurus are reducing positions is a yellow flag. Insider ownership is extremely low at 0.32%. Meaning Bristol-Myers Squibb's management team owns virtually none of the company they lead. This creates a potential misalignment of interests. Over the last 3 months, there have been 0 insider stock purchases and 1 insider stock sale, which is another bearish signal from those closest to the business. In our view, the smart money picture is cautionary. The reduction in guru positions, the low institutional buying, and the complete absence of insider buying all suggest that those with the best information and longest track records are either indifferent or moving away from Bristol-Myers Squibb. And finally, the verdict. Let's bring it all together. On valuation, Bristol-Myers Squibb trades at a premium to intrinsic value with an elevated PEG ratio, though the forward price-to-earnings multiple is reasonable. The margin of safety is negative, and Wall Street's bullish sentiment is tempered by broader sector headwinds. We view the valuation as stretched at current levels. On financial strength, the balance sheet is moderately leveraged with manageable debt service but limited liquidity cushion. The strong Piotroski score is encouraging, but gray zone bankruptcy risk warrants ongoing monitoring. Overall, we view financial strength as adequate but not exceptional. On profitability, Bristol-Myers Squibb excels. Margins across every measure, gross, operating, net, and free cash flow, are well above average and reflect the structural profitability of the pharma business. We view profitability as a genuine strength. On growth, the picture is concerning. Single-digit revenue growth, negative book value growth, and a mature patent portfolio suggest the company is in long-term decline offset only by capital returns to shareholders. We view growth as a critical weakness in the investment case. On smart money, institutional investors are reducing positions. 13F filing buying is muted, and insiders are not supporting the stock. We view smart money sentiment as a caution signal. In our interpretation, Bristol-Myers Squibb is a mature, profitable pharmaceutical company with a fortress-like balance sheet and exceptional profitability, but it is facing a structural headwind from patent expirations and lacks meaningful revenue growth. The valuation appears stretched relative to intrinsic value, and the smart money is voting with their feet by reducing exposure. For investors, this setup warrants caution unless you have conviction in management's pipeline to reignite growth. Everything in this video is our interpretation of publicly available data and not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Bristol-Myers Squibb. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.